Are you going to go and have your conclusion challenged, or are you going to go and look for it to be reinforced? We don't spend enough time analyzing our failures. You could get emotionally dragged in to chasing trades that you shouldn't be chasing.
It's funny, that's the thing. People get addicted to unrealized gains. So they see, their trading account, it looks great, or crypto account, and they don't take profit, and then it looked good at one time, a good screenshot, right? I remember actually in 2021 when I came out to see you, and people had stuff stuck in their gardens and saying AMC to the moon, and it was on the back of people's cars. It was crazy. So
absolutely, and that's the conformity biasy. That's the herd mentality biasy, because you're in that grouping and you feel like it's going, and you're not, again, you're now caught up in the emotion. Again, now you got limited self-control. Whereas if you made those decisions about AMC long before all the emotion got involved, it would have been a clinical decision. But as human beings, we've got to understand that we're flawed creatures. We are not able to make good, rational, sound decisions all the time. We're emotionally driven by stuff, and again, it's how stuff is framed. You get framing biases, you get anchoring biases. Those are things that impact us too. There's times that, like, for example, let's say you're in sales and you got a management team, they come to you and they say, what's the chances of you winning this order? And you say, well, a flip of a coin. They're going to probably look at you as a sales guy and be like, you don't know your customer, you don't know your market, what am I paying you for? Your complete business is based on the flip of a coin. So it's 50% chance of getting heads or 50% getting tails, 50% of winning, 50% of losing. What do you know about your business? Now, if you reframed that and you said, management team comes to you and says, oh, I see you're working on a big project. What's the chances of you getting that order? And you're like, right now it looks about 50%. They think you're a superstar. Yeah. Because they don't see the negative, they see the positive, 50% of you getting it. Yeah. So they're already subconsciously spending money in their head of you winning this big project. But if you say a flip of a coin, or you say 50% chance of winning it, it's exactly the same chances, it's just how you framed it. Yeah. So if you bring that to the financial markets and you're doing your analysis, and you look at a management team and say the last quarter they reported earnings of 121, and then off that quarter they said we expect earnings of 130, and they report 127, the management team has created a frame for you. So now they've created a frame that says next quarter is going to be 130, but if they report 127, you're going to consider it a disappointment because they framed your expectations to 130. Now, if they didn't create that frame and they said we expect it to be a good quarter coming up, and they go from 121 to 127, you'll consider it positive because it's an improvement. But because they set this frame at 130, they've elevated your expectations. And this is a framing bias that we also got to be conscious of.
Yeah. So what's the difference between anchoring bias and framing bias?
So framing bias is setting up the information, setting up the event, giving you an idea of how it should be. Now, anchoring bias is when you look back at stuff. So, for example, if you take a T-shirt, you look at a T-shirt and you see this T-shirt priced at £1,000. And you're like, well, that's a little expensive. Anybody that doesn't think it's either got a lot of money or a different value system. But then you find another T-shirt and you look at it and you see it as £100. Now, because you've got that anchor of 1,000, this T-shirt for 100 seems extremely cheap, right? So they've anchored you to this £1,000. So now you've got this T-shirt at £100 and you're like, oh, that feels reasonable. So now if you take that into stock prices, so perfect example would be GameStop. You could see GameStop at $600 and now it's traded down to $300, and you're like, well, GameStop's cheap because you've been anchored to the higher price. Now you see GameStop at $300 and you're like, well, that's cheap because somebody thought it was a value at $600 because that's why they took it there. And now you're thinking, well, I'm buying it at 50% off. But if you don't do additional research and you don't do additional analysis, you don't realize that GameStop at $300 is way overpriced. But because you've got it anchored to 600, you think it's a bargain. So that's where anchoring biases comes in and what you need to be conscious of. Because something was once priced at a level doesn't mean it was worth that, and it doesn't mean it's worth 50% of that today.
Yeah, it's interesting. I think human behavior, you think is changing, but I feel that it's just humans, right? I think that, you think that, I think because there's more evidence and there's probably more studies that's happening now with human behavior and seeing how that social influence is also included in human behavior and how we act differently because of the information overload that we have as well. I think it's become brought more to the forefront now, but sometimes I think humans just humans because that's the way we are. We're emotional creatures, and our emotions do tie us to sometimes bad decisions and sometimes good decisions. I've actually made a note because Tony Robbins has this thing called the 6 human needs. I'm not sure if you heard of it. And one was certainty, so the assurance that you can avoid pain and gain pleasure. 2, uncertainty and variety, so the need for the unknown change and new stimuli. Significance, feeling unique and important. Connection or love, a strong feeling of closeness or union, which we see a lot.
Yes.
Growth, so an expansion of capacity and the capability of understanding. And then the 6th one's contribution, so a sense of service and focusing on helping, giving and supporting others. Now, you'd like to think that everyone operates on all those 6 human needs at a nice sort of scale, right? But I suppose we probably give more to some of those and probably neglect some of the others as well. Now, do you feel that looking at those and trying to see how they connect with some of the behaviors of finance, that those biases, do you see the connection between those human needs and the biases in the behavioral side of finance?
Well, what I would say from that is that all that is based around emotion.
Yeah.
So the sense of like Tony Robbins was like giving, that's an emotional experience. So when you're in service, so like people have done studies around happiness, and they say that people that have find themselves in place of a happier place is that very often they're in service in some form. They're either teaching youngsters and helping them on their journey forward, or they're in service helping people that has a greater need. But they feel like, again, in some sense, it's a selfish act because you're getting some happiness out of it, but you're also in service. So it's emotionally driven. So I would say that everything that we get involved in, good, bad, or indifferent, has a fundamental emotional starting point. So depending on where our emotional state is. So for example, there's some mornings I wake up and my head's in the shed. I'm not on my game. I don't feel good. So I got to disrupt that behavior somehow, So some people take a cold shower. Some people do some meditation. Some people go to the gym. But, you sense in yourself that you're emotionally not right. And then there's other times that you wake up and you're emotionally on top of your game and you're really in a good place. So when you're starting to make important decisions, whether it's around investments, whether it's around trading, whether it's around your future, you need to make sure, in my opinion, that you're in a good emotional place. And then until you're in that good emotional place, or you don't have external effects acting upon you, I would table that decision. How often have people been out drinking in an evening, and as the night's gone on, their behaviors, their decisions get more aggressive, not violently, but like, oh yeah, I'm up for jumping out of a plane. Let's go do that. Now at 4:00 in the afternoon when they're sober, it might be the last thing that they're thinking of, but now their emotional state is changing. They're feeling a little bit more ambitious, and now they're like, oh, okay, let's do some crazy stuff.
Yeah, I think the brain produces only so much glucose per day, and I think that's one of the reasons that they say that people make worse decisions in the evening, and then you add alcohol to that. Then
yeah, absolutely.
But yeah, I think that a good point there is they say what gets measured gets managed, right?
Yes.
So do you think I hear a lot of people in trading, for instance, 'cause I know you're a trader, journaling in trading, and journaling your trades is one good thing, but I feel that journaling everything, so if you journal and you made a note of the time you woke up and went to sleep, what you ate throughout the day, how much water did you consume, did you do any activity, did you go to the gym, did you go for a run, If you have some sort of manifestation list, did you write out your manifestation list? Did you do your meditation if that's what you want to do? All of those things. If you can track this every single day and you have a good day and then you score that day at the end of the day, then when you're having a bad day, at least you got something to go back to and be like, look, that I felt good that day. What did I do different that day to today? Sometimes, chemical balance might shift and it may be out of our control, right? But usually if you track stuff, you can look back at the data and usually find out where you're going wrong in some way, shape or form, unless it's something outside that you can't control. I suppose it's the same with trading, right? People can get swayed over time. They start changing their strategy slightly and then they look at something else and it looks pretty cool. So they try something new. And then before you know it, over time, these small changes compound for the better or worse. So what's your thoughts?
Absolutely, I think journaling is important, and the problem I think is happening in today's world is that we don't spend enough time analyzing our failures, and we're getting into a place in this world where we're not putting any value on losing or failing. So you think about it, right? If you are in a business and you lose a big order, everybody wants to sit down and dissect it. And they'll try to understand it. But if you win, nobody will spend any time studying why they won. So it's going back to your conversation or question around journaling on trading. So when you trade and you journal, you should be reviewing both the positive wins and the losses, because you need to understand, did you win it? Because it might not have been a winning trade, but it might be a win because you didn't take a huge loss. Because you set that stop loss, you got out of the trade, and you didn't look to the hope god. Yeah. You were disciplined. And was that trade set up on a Saturday or a Sunday when the markets weren't emotionally driving your decisions? You were in an isolated event, and you could then be able to make a logical, sound decision. And then even if you did have a winning trade, let's say Monday morning, the markets opened up down, but by the afternoon they were up and you bought that morning and you had a winning trade. Is that truly a winning trade if you didn't follow your discipline? You have a winning trade because you've put more money in your bank account, but if you didn't follow your discipline and you didn't set up your trade like you should have, then to me, that was a losing trade. Because basically you're going to now get into the risk of self-serving biasy there, because you're going to look at that trade and say, look at me, what I did. I won that trade. Now, it's not the market won you that trade because you didn't go through your step-by-step plan, whatever that plan is. So you need to be conscious of our winning trades, truly winning trades, and our losing trades, truly losing trades. Because if you followed your discipline, I wouldn't consider it a losing trade. And if you didn't follow your discipline and you made money, I wouldn't consider that a winning trade.
Yeah, I think that the last, 18 to 24 months has been difficult for investors in a way that we got hit with a ton of uncertainty in March 2020. And all of a sudden, arguably the best 12 months most investors could have had if they was in the market. And pretty much any market, right? Could have been selling Jordans and you would have made money. And now, where we have the sort of the economic landscape changing, and now a lot of investors don't know what to do with their money because they're like, well, we've got inflation, we've got rising rates, markets don't look great, they look very volatile. And in these situations, do you feel this is where you see a lot of investors, they tend not to adapt, or they try and adapt and then they move away from their initial discipline that they had and their normal strategy and they change it? And I'm saying that you do need to adapt to certain situations, but they change it and then start taking on more risk because they're not getting the upside that they've seen over the past 18 months. Is this a dangerous time for investors?
Yeah, if you're not conscious of a lot of the biases that we've talked about, you're now in this podcast, the situation is that you could get emotionally dragged in to chasing trades that you shouldn't be chasing. So to me, what you got to do is you got to look at it and be like, okay, where are we at a macro level? So with COVID, we saw governments around the world pump so much money into the system that it became a slush fund. Okay, so now those governments are saying that there's too much money in the system, and we're now experiencing high inflation, the highest inflation in 40 plus years. So now we got to start taking money out of that system. So the U.S. federal government, the Federal Reserve, not the federal government, the Federal Reserve is now going through a tightening program. So they're bringing billions of dollars out of the market. So now the business model of some of these companies are going to change. So when you look at it from, so like I trade on technicals, but if you look at it from a fundamental standpoint, if you look at the tech stocks here recently, you know, they've all really collapsed. You know, PayPal is down, Metaverse is down, Google is down, Amazon is down. So why are these companies down? Well, the challenge that we've gone now from a true fundamental financial basis is that those earnings that those companies were throwing off through the discounted cash flow model, we're now at a higher interest rate, so their present value is going to be affected. So for those companies to have the same value, they need to come down in price because those earnings are now being offset against higher interest rates. Yeah. So that's a factor that's playing into it. So and we're in an interest raising environment right now. So the Fed at the last meeting raised it 0.75 of a point. Now you've got people on both sides. You've got some people saying that they're not raising enough and aggressively enough, and then you've got some other market managers that are saying they've gone too far too quick, and we need to slow this down because there's obviously a delayed effect of those interest rates getting increased and working them through their way through the system. Now, if you start looking at some commodities, so oil is down. I think oil was trading today in the high 70s. Copper is down. Copper is down around $3, known as Dr. Copper. That gives you an idea of how the health of the globe is doing, and copper is down from where it was. Natural gas is subsiding. So a lot of these commodities that the Federal Reserve was concerned about inflation is starting to come down and it's starting to take effect. Now, the sticky ones are shelter, you know, whether it's rents or whether it's house prices. And it looks like they're going to be pretty determined to break that. So, and if you look at the bond markets, I think the 10-year is just shy of 4% in the States. The 2-year is higher. So there's an inversion of the curve. So that basically tells us we're going into a recession traditionally. So it's there. So there's definitely uncertainty out there. But what I feel like's happening is that we are moving back to what I would call traditional investment basis. You know, we are looking at the fundamentals of companies. We are taking into consideration the business climate and the economic climate. Whereas with COVID, there was so much money going around that, you know, companies like GameStop and AMC was going through the roof.
Yeah. So basically, now we need to look at companies that actually make money
exactly
and that are productive instead of just putting money into anything.
Absolutely.
Yeah, it's been a crazy environment. So do you feel, though, I think a lot of the things that are going on in the world now, you know, from the grassroots up, really, you know, I have children and I've noticed a lot of, you know, an environment where everybody gets a trophy environment. And I do feel that, you know, it's happening at all levels of age. And you know, I do feel like you said there's value in failure. You know, no one likes to fail, but if you fail and you know you failed, usually you want to know why. Yeah. And you want to know what went wrong. Why wasn't you better than the other person or the group of people or whatever it is? So I do feel that there's value in failure, and I feel that it's quite a toxic environment if you're going to create an environment where nobody can win, nobody can lose, and everybody. You know, we're trying to. You know, for me, I feel that the environment we're in now, who knows, we could get a decade of stagflation. We don't know, right? Who knows? And, you know, you need people to be productive to grow, and to get economic growth, you want productivity and you want people to be able to work, regardless of whether that's working smart or hard, you need work to grow, right? Now, for creating an environment where there's going to be a lack of ambition, where are we going to get that from? And, you know, tech, as we know, is deflationary, and, you know, look, technology, you're not going to stop it. It's growing at a crazy rate. AI is insane, some of the things they're doing with AI. But, you know, for people to just opt out the labor force completely now because of lack of ambition and maybe handouts, what do you think that does to the human race?
Well, I'll tell you. So going back, I know this podcast a little bit about the human mind and behaviors and all. So being a student of human behavior, and it fascinates me, like probably you and most people. There was a study done here recently about praise around children. So they had three groups of children. So the one group, they gave them some puzzles. The second and third group, they gave them the same puzzles. But the difference was the first group, regardless of how they performed, they praised them and said, you did good, you solved these puzzles, it was excellent. The second group, they praised the process. So they were like, okay, you might not have achieved this in solving the puzzle, but you stuck with it. The third group, they offered no communication. So when they did this with the children, they then gradually moved the children through the difficulty of the puzzles. So the first group that was, if you will, used to getting all the praise because they're just brilliant, as they moved through to the more difficult puzzles, they lost ambition because they didn't get the praise that they were hoping for. The second group that was involved with the more difficult puzzles, because they got praise because of their effort and their performance of sticking with it, they continued to work through the more difficult puzzles. The third group did it, but when they were offered to take the puzzle home to continue to work on it, they said no thank you. The first group was offered to take home the difficult puzzle and asked to work on it, and they said no thank you. So the middle group, the second group, when they were offered to take home the puzzle and work on it, they took that opportunity to take that puzzle home and continue working on it. And so the people that carried out this experiment and this study associated the reward of the process versus the reward of the result. So where I would take that is like, if you're involved with someone, whether it's children or you're a team leader, is that look to the process and reward their efforts around it. Because if you just reward them on doing something and getting an end result of success, then it looks like people aren't willing to challenge themselves. They're not willing to move outside of that comfort zone that we talked about earlier. Whereas the children that had the more difficult puzzles were still willing to move themselves out there and still willing to expose themselves to failure, because they knew failure didn't result in them not getting a compliment. They realized that failure resulted in them getting acknowledgement for their effort and preparedness. So failure wasn't the absolute win or loss. It was the process. Whereas the first group, they realized that as soon as they failed, they got no praise. But they got so conditioned to praise that that's what they wanted. So they were like, I'm not going to push myself into an area where I'm challenged, because if I go into that area where I'm challenged and I fail, then I'm not going to get praise, and I want praise. I need praise. So we've got to be careful what we do with the youngsters and how we reward their efforts.
Yeah, I think as well, most people, if you asked most people and said, are you where you want to be right now? Most people probably say no. And if you said to them, look, design your life on this piece of paper, how do you want to live? They would write something down, and if you ask them the question of, how are you getting on, like, moving towards that life that you've designed, I think a lot of people, the lack of discipline is hard, and I think that what you just said stems from those early days to have a lack of discipline, and it's the consequence of what if you don't, what if you don't try? What's the consequence of not trying to get what you want? And then failure doesn't seem as bad. If you can design a picture and you can visualize something that you want, and then you ask yourself, what's the consequence of not trying? Failure never sounds as bad then.
Absolutely.
But it's hard for people to really, one, visualize what they really want, and then two, seeing themselves actually getting it. People find that hard. And I think a lot of it's just conditioning over time. And, if you condition yourself into a very comfortable environment where you don't have to do a lot, and it is hard to pull yourself out of it. And, you do need to change your environment. You need to change probably your habits, your day-to-day habits. But yeah, we want things, but a lot of people they lack the discipline, or they associate the discipline is something that's so hard they just, I'll do that. I'll procrastinate. I'll do that tomorrow.
Absolutely, and I'll tell you that's a big thing for me. I that's how I distinguish motivation and discipline. Motivation gets you moving. Discipline keeps you moving, and discipline is doing the things that you don't want to do when you must do them. You know, so like I know you've done boxing, and I say, look, it's easy to win the fight from the corner. It's much harder to win it from the bottom of the canvas.
Yeah.
And when you're led on that canvas, it's easy to throw in the towel, but it's your discipline that gets you back up. And that's the same with business. That's the same with trade in the financial markets. And that's where your discipline comes in, is having the discipline to say, I'm going to review why I made these trades. I'm going to review why these trades came out for me in a good way. And I'm going to review why these trades came out for me in a bad way. And I need to understand this. I'm not going to just accept the result and move on. And that's where the journaling comes in. Yeah. And again, you know, I know we talked a lot about behavior and the psychology of behavior, and is understanding how all these flaws in the human mind and the human psyche is impacting my ability each and every day. You know, and it's every day, you know, where like if you've got children, there's times that your children might frustrate you and you lose your temper, and that's an emotional reaction. You know, I got a niece and nephew, and I've sat down with them, and they say they don't want to do this and they want to do that, and I try to get down to their level and have a discussion. But you know, it's easy when you're not parenting 24/7. You know, those kids can wear you down, but it's all emotion. Everything is emotion. Those children are reacting emotionally. Their parents are reacting emotionally. When you're doing sports, you're out there and you're emotionally involved in the sports. It's all a challenge emotionally.
Yeah, I think, like you said, look, discipline, that does separate discipline from motivation. When you do wake up and the things you don't want to do, you do them anyway. And, you know, everyone has off days, right? To be fair, most people have more off days than good days, you know, and when you have the good days, you want them to last longer. And then when you start having off days, you wish the good days came back. But yeah, you just got to get up and do the things that you know you need to do, but you don't want to do, regardless of how you feel on the day. But yeah, I think that mental conditioning in everything, that brings all the biases in, that brings just overall human behavior, the emotional decisions that you make. It all comes down to conditioning. And I feel that, you know, if you can condition your mind in a certain way, you'll make better decisions, and then you're going to be more aware of the decisions you make. And I think awareness is probably the most important part, because if you do make bad decisions, but you're aware that you've made a bad decision and you understand why you've made it, or you're happy to look at the process of why you made it, rather than look for confirmation bias to say why you was right, then yeah, I think that's what I think is the most impactful part of it, is the thing where you're aware of where you've gone wrong.
Absolutely. Yeah. And if you look at everyday life, so you can look at everyday life and start asking yourself and start challenging yourself, where are your biases? Where are you more biased to one thing or another? So a perfect example is that, you know, some of your listeners may travel for work. So let's say that you're traveling for work and you get into a new town, and it's like 6 o'clock and you come out of the hotel and you're like, I'm going to have a bite to eat. So now you look across the street and you see 2 Greek restaurants. And one Greek restaurant is full of people and the other one is empty. So now you look at it and you're like, well, which one am I going to go and dine at? The chances are you're probably going to go to the busy one. That's a herd mentality that's stepping in. So now with that, and that's what most of us will do. It's not a bad thing. Yeah. It's just what most of us will do. It's because, and then we'll start self-rationalizing the decision by saying, well, the food's probably better because they got the crowd in there. Whereas the other one, the food can't be that good because nobody's in there. So you'll start justifying that decision. So now you start and need to ask yourself, why am I justifying this decision? Why don't I step away from the crowd and try this restaurant? But maybe you will, maybe you won't, now having listened to this podcast. Yeah. But these are things that you need to be conscious of. Now, let me introduce another data point in there. And somebody walks up to you on the street and says, well, which restaurant are you going to have dinner at tonight? And you're saying, I'm probably going to go with the busy one. And they'll say, why? And you're like, well, it's busy. Food's probably better. But then they whisper in your ear and say, oh, that's a marketing ploy. And you're like, what do you mean? Well, half those people in there are actors to drive business. Now ask yourself, how would you change your decision? having that new piece of data point? And how would you emotionally re-engage in that decision? And how would you reevaluate? And would you still go there knowing that half of the clients in that restaurant who you thought were there because the food was better are now paid actors?
So how do you feel that people could, be more aware of their decision making? Because like you said, people self-rationalize. We try to justify our decisions, every decision we make. Even when it's wrong, people's ego gets in the way, and they'll still try and justify a way to why they made their decision. So where do you think a good place to start would be for somebody to, if there's somebody that does these things?
Well, I think you hit it on the head there with ego. First of all, check your ego. Ask yourself, be honest and say, are you an egotistical person? So when it comes, like when I talk to people about trading, they're like, well, I was right. And I'm like, let me ask you a question. Is it more important to be right, or is it more important to make money? Because as human beings, especially males, we got this desire to always be right. I'm always right. And we'll argue it to the bitter end, especially when you're young. It's like, I'm right. I know I'm right. So when you're trading, if you are in a position where you got more of a desire to be right than to make money, then I think you need to step back and ask yourself, is trading for you? Because you got to be humble enough to say, I'm wrong. Because a good trader is probably right 40% of the time. So that means 60% of the time, this guy's got to admit he's wrong. And if you can't admit you're wrong, you really got a problem. So first and foremost, you need to get that emotional place where you're comfortable with saying, I'm wrong. So once you've got through that ego thing of like, yeah, I can admit I'm wrong, I don't have a problem, and be honest with yourself, then you start to need to be honest with everything else in your life. So do you, when you formulate an opinion or draw a conclusion, do you then go and find people to support that? So for example, let's say you're not a very religious person, and you've done a lot of reading and a lot of research, and you've decided that, no, organized religion is not there for me. And I'm not saying, good or bad about it. Now, do you go and find someone to help reinforce that belief system? So now do you go and hang out with other atheists or agnostic people? Or do you say, hang on a second, I'm going to go and explore religion, and I'm going to go and have a beer with a Catholic priest, or I'm going to go to a Buddhist temple, or I'm going to go and start it. So now if you ask yourself what type of person you are you going to go and have your conclusion challenged, or are you going to go and look for it to be reinforced? So if you're going to go and look to have it reinforced, then you need to step back and say, hang on a second, am I experiencing confirmation bias here? So you need to keep always analyzing, always questioning, in my humble opinion.
So stay curious.
Curious. Absolutely.
I think, that's a good point. I do feel that self-awareness is so powerful. If you can master, or you don't have to master it, but even if you can just get some self-awareness where when you're doing something, where you are looking for a bias, or whether you're looking to justify a certain decision that you made, if you can be aware of it, that's going to get you 90% of the way there. And then the other 10% is most likely going to be, look, I need to look at the other side here, and the counter argument.
Yeah, and look when you go down, maybe, you can listen back to this podcast, and you can listen to all the different biases that we talked about, take notes of those biases, and then every decision that you make, go through those biases quickly and be like, am I concerned here? Have I got overconfidence bias here in place? Am I experiencing hindsight bias here? Have I got a framing bias going on? Am I got an anchoring bias going on? Look at all those different biases and start asking yourself, are some of those showing up in my decision? And they may or they may not be. And then dig in a little bit deeper and try to figure out what may be influencing it. Maybe nothing is. It just is what it is. But dig into it.
Okay, so we've covered a load of good content today. I usually ask all my guests a question at the end, and I think the question I'm going to ask you is, if there's a billboard in Times Square and you could choose what it said on the billboard, and it would hang up there for a month, what would it say?
It would say, learn how to learn, or learn how you learn, because we all learn differently. And I think the greatest value to someone is education. And I think if you can discover it, how you learn, then it'll help accelerate that journey and make that journey more rewarding. So learn how you learn.
Nice, nice. Well, like I said, I appreciate you joining me from stateside today.
Absolutely.
And yeah, always enjoy you as a guest, and we'll have to do it again.
Absolutely, and I hope the listeners enjoy it. Thanks for having me. Appreciate it.